We're going to learn about the Kahuna, Eureka, and Phoenix. And on the next slide, we have a full agenda, so let me take you through it. These are impulse indicators, and they're in sync with the emotions of the market, and we'll show you that. And then just an elementary understanding of what Bollinger Bands are and fat tails. Don't let your eyes roll in the back of your head. I will just keep it very simple, and all you need to know is where is fear and greed. And that's the whole purpose of understanding these techniques, which are developed on top of what Richard Arms and John Bollinger had provided before. As I say, the key characteristics, and we'll cover the key characteristics for those of you who want to know the innards of Eureka, Phoenix, and Kahuna, and how they work together for a heads-up and heads-down signal. We'll discuss the value of these indicators with examples so that you can see in both in previous on slides and also what Ron will take you through, how these indicators will help you get in and get out and stay on the right side of the market. They're in fact trigger signals for buying and selling, and they are available, I should say, on the HGSI software. Next slide. Well, as you can see, here's the standard picture that you've probably seen from time to time of the emotions of the market, and they rule the market to a large extent. You've got to understand when the market is optimistic or when it's euphoric, and when then, of course, it trots down to fear and despondency and depression. Lately, of course, we've had a long rally, and the best part of 22 weeks, and therefore things are a trifle euphoric, and you'll see that in a moment. Next slide. Well, here we are, and as I promised you, it's the HGSI House of Impulse Indicators, and pictorially here are all the various indicators that we've come up with. They're particular to HGSI. You won't find them anywhere else. And we're going to waltz through 3 of them tonight. So without further ado, let's move to the 3 that we concentrate on. I told you I'd give you a very quick introduction to Bollinger. And essentially, here's what got me interested when I was reading his book. It said that 89% of stocks sit between 2 standard deviations. And you're saying, what on earth is a standard deviation? You don't have to worry about that. The important point is that that's close to what is called the normal distribution, whether you're measuring the height of people or the weight of people, or in this case, stocks. But the important thing is what I'm showing on the left and right-hand side. And that means that there's 11% to be shared between fear and greed in the fat tails. And what I have done is to leverage the work such that we're concentrating on looking at that fear and also the greed, so that at least we've got some early warning indications as to when the market is top heavy or when it's oversold. Next slide. Yes, I told you we're going to blend Richard Arms's work with John Bollinger as I have applied it. The first 2, Eureka and Phoenix, are out of the Richard Arms, and I'll show you that in a second. And the third one is, of course, what I call the Kahuna. Both a Kahuna up and a Kahuna down. All you have to remember is that it's a one-day change. And I'll show you how important that is, because that gives you a feel for the momentum on a particular day. You can't have one without the other, I say, and you'll see that. Next slide. All right, so let's look at arms first. Eureka, bulls are strong. Phoenix, bears are strong. As you know, Phoenix came out of the ashes. Therefore, in order for it to come out of the ashes, it must die first. And the bears, of course, when they're strong, they take the market down. Eureka, I said Eureka when I found the formula that said, look, we've got a bull market. So that's how we came by the names. Next slide. And here's what Eureka is. It's known to HGS investors as a heads up, a turnaround day after a market bottom, or a follow-through day. Those of you who are CanSlim investors will immediately understand a follow-through day. soon thereafter. But what we found is, based on the statistics that we have, that this has turned out to be an excellent go-to indicator to confirm that the follow-through day is in fact a good signal. Next slide. And here, as I promised you, back in 2006, on this slide, was the first challenge that I had in terms of Eurekas. Now, you see those green bars down at the bottom? That triggers every time there is, in fact, a Eureka. And you say, well, what's a Eureka? Well, there are three conditions, and there they are on the left. You have the advance to decline ratio, must be less than 3. The advance to declining volume, 5.40. And the arms index, which is the top one divided by the bottom, 0.63. If those three conditions are met or bettered, well, then you get a signal. And of course, my first brush with seeing things go haywire, because these were supposed to be very infrequent signals, was back in 2006. And of course, most of us can't think back to then, but there you are, you see extreme volatility. And you'll begin to understand that in a moment as we move from there. But nonetheless, this has proven to be an excellent signal to indicate when a fresh rally is starting. And as you can see on the last two green bars there, that's the start of the new run. And we'll show you a lot more of that. Next slide. And there you are again for confirmation, is the numbers in bigger caps, so that those who are a little bit challenged like I am can see it in those numbers. Next slide. See, I give you all the data. And here is the Phoenix, which is the converse. It's a turn down day, a big red candle day after a market top, or a distribution day, or a correction soon thereafter. Several of them in a row will turn the market to a correction. And you say, well, of course, if I'm getting big red candles, what more do I need? Well, we'll show you. Next slide. And there are the numbers in terms of the requirements for a trigger for a Phoenix. You'll notice that at the bottom I have some late breaking news, and as a matter of fact we have two signals, two sets of signals, and they all appear automatically for you. You don't have to do a thing, the software will do it all for you. All right, that's given you a flavor for those two. Next slide. Now, here you are, going all the way back to 91, and look at the sparsity of signals way back until around about 2001. I mean, there are very few. And if you look at the table on the left-hand side, they were, in fact, infrequent. But then you hit 2002, and there you see right in the middle of the chart, 12 Phoenixes and 3 Eurekas. Well, of course, the market was being trashed, as you can see. And you say, well, Ian, what about the right-hand side? Well, it's worse, and you know that. You had to, in fact, engage in this market with this kind of volatility. But nonetheless, it does, in fact, give you confirmation of when the market is dying and when, in fact, there's a rebirth. So we'll show you as we move along. Next slide. And now that's taken care of arms, rigid arms, and you now understand, hopefully, a Eureka and a Phoenix. Eureka, thumbs up. Phoenix, thumbs down. So now let's look at the gems a la John Bollinger. A Kahuna, up, and so we'll talk to percent B and bucket skipping and grandma's pies in a moment. All of that comes in. Now, for your benefit, I'm not going to spend time here on these next two slides, but you like to go away and say, well, what the heck is Bollinger all about? And on these two slides, I've extracted all you need to know about John Bollinger. I shouldn't say that. There's a lot more. But for this purpose, there are the formulas for bandwidth, as you can see on the item 6, and also for percent B. And I'll be discussing mainly percent B, but I'll show you how they interact between percent B and bandwidth as to when to buy and when to sell. Next slide. And there's the rest of it. So we'll just move on to the next slide. All right, so now what is these kahunas all about? As I say, they work hand in glove with Eureka and Phoenix. The latter two relate to the market, that's as I explained. But the former, the kahuna, will relate to the stock, an ETF, an industry group, a market index, or your own portfolio index. So it's very powerful in telling you when there has been a change in momentum in one day. One day, mind you. And as you can see there, I call them kahunas because they're stout. All right, a little kahuna plus 0.24 up in one day. That means that if it's at the lower Bollinger Band of 0, it will have jumped up to 0.24. And if it's a big kahuna, it would jump up in one day to 0.40, a big change in both volatility and momentum of your stock, of your industry group, of your ETF, or the market index, as you'll see. So the same thing applies, of course, to the downside. So let's take a look at this. Next slide. And here's a busy chart, but let me just give you the basics of it. As you can see, the outer and the upper and lower Bollinger Bands are shown in blue, and the middle Bollinger Band is in dark green, as you see. And there, of course, is the index trotting up and down for the super composite 1500 in the time frame of 310 through, 1209 through 1010. And what you immediately see is I've marked a big kahuna up, and you see a big green candle, and a big kahuna down, and there's a big red candle. And if you look down at the bottom, you will see there are corresponding dark blue and dark red. Those signals are, in fact, inside 2 seconds, you can tell whether you've had a really rotten day, and they guide you as to what comes. Now get your eyes over to the right-hand side for a minute, and you will see down in that bottom chart, 2 charts. Notice that there are 1, 2, 3, 4, 5 Eurekas in a row, and there's the market going off. And by the way, as I'm going to show you time and time again, you get 2 Eurekas and a kahuna, and it's off to the races. No ifs, ands, or buts. That is the signal that you've got to watch for. Next slide. So here you are. I talked about the cup being half empty or half full, and there it is in diagrammatic form. If you're at the lower Bollinger Band of 0 and you get a 0.4 up, well, that's a big move. Likewise for a down move. But that gives a different representation of volatility and momentum. Next slide. Here we are, March 2010. So a year and a half ago, a little bit less. At any rate, I put up Polo Ralph Lauren at the seminar, and look at it down at the bottom. I promised you a little kahuna, 2 Eurekas, as you see down there. Market, of course, at that point in time, had collapsed at 57% down on the overall market. And here this thing trotted off with a signal. Remember I said the kahunas relate to the stock. So we're looking at Ralph Lauren. And there you see it to the right, 60% move in 6 weeks. Not bad. But more importantly, look up at the top window. There you have the percent B coming up, I should say, through the bandwidth. The bandwidth is the red, the green is percent B. And all of that dovetails together. When those strike, you get a signal. Next slide. And you say, oh, that's very well, Ian, 60% move. What has it done since? Okay, look at it. I was showing you the left-hand side, which is shown in green. And, of course, here we are in October 2010 with this snapshot. And look at the move. I mean, from around about 36, shall we say, to 90. By heavens, that's over a double. And, of course, naturally, with it extended as it is, it had to correct. Now you're going to say, Ian, this is a very confusing chart. But I tell you, once you get an understanding from Ron and myself, as we cover these various impulse indicators over the next, this and the next 2 sessions, you'll understand that this is the roadmap to hog heaven, hopefully. As you can see, there's splashes of red and there's splashes of green, and when there's splashes of red, of course, the market dies, and that's what you'd expect. And down at the bottom, look at the volatility that you had to put up with in terms of Eureka's and Phoenix's firing. So that's what we're going to look at. Next slide. And here's Ralph Lauren one more time. And Ron will show you this in real time as to where it is now. But as you can see, it's got clobbered again. But after all, it's gone all the way from 36 to 115 through all of this. So that's an indication of being on the right side of the market with the right stock, and you decide when you get out. Next slide. You say, Ian, Ralph Lauren, what about lots? Look at it, the same thing. This time, you got 3 kahunas, bang, 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 within a week, and look at that big blue one. And we're off to the races, and 100% up in 10 weeks. So let's look at another one. Next slide. And there it is again, 2 kahunas and 2 Eurekas. You think that this is by happenstance? No, of course not. It's part and parcel of what we're trying to do by way of showing you, giving you insight into impulse indicators that says the rally is on, get in. Try the next one. So now you've got the message. There you are, there's 4 in a row. And there were umpteen of these at that point in time. You've only got to go into HGSI and look back at that stage and put up any chart. As a matter of fact, as I'll show you in a minute, all of the market indices that we follow, all of them fired at that point in time. And I'll show you that. All right, enough of that. That's a broken record. But I tell you, that is the value of what you're looking at in attending this little webinar. Next slide. All right. Are there any questions at this time? I don't see any. I think you like it. Well, I hope so. I don't see any questions. Nobody raising their hands. Nobody writing anything. I'll press on. All right. Harnessing the market with percent B. It provides instantaneous reaction to market fluctuations, as you see. Consistency for market indices, ETFs, and stocks. That's the beauty of this. This applies to anything. It gives you, as you've seen, the ebb and flow at extremes. And they will give you those 3 clues. Then bucket skipping. Oh, Ian, another term, bucket skipping. It'll all be apparent to you by the time I'm finished. But that's an important concept. Now let me just spend a second or two on bucket skipping so that you don't keep scratching your head as to what does he mean. Well, when I say that we have a little kahuna of 0.24, I have, as you will see, split the percent B into 12 buckets. Those that are below 0, those are between 0 and 1 into 10 more, and that's greater than 1. As I'll show you, that's 12 buckets. And of course, if you get a 0.24 move, then you've skipped 2 buckets. It's as simple as that. If you get a 0.4 move, you've got a 0.4 bucket skip. You've got to sit up and take notice something has changed dramatically. And all of that help us in terms of understanding the yardsticks for the 3 road scenarios, as I'll show you. But more importantly, it gives you, hopefully, early warning that you better be doing something with your precious nest egg. Next slide. And you look at this and say, my heavens, Ian. Yes, look at it. I'm showing you what transpired at the flash crash at that time frame. If you remember, the market peaked at 423, April 23rd, and then, of course, it died. And eventually there was that big red candle down on 5-4 or thereabouts. And, of course, it turned the market into turmoil with what happened there. And we had a 17% correction. Well, I'm sure your nest egg took a bit of a heat. But more importantly, having come out of all of that, look at the right-hand side, and there it is. I say hope. And you only got to look at the top, and you see a lot of green, but it's a tiny green. Hope. And down at the bottom, there it is on the market, on the NYSE composite. Two greens and one blue, a Kahuna and a Eureka. And look, there she trots above the declining tops line. So the answer is the next rally is on. Let's look at the next slide. There it is. So hope turns to joy, and she's trotting. 5 unanswered Eurekas and 2 Kahunas in 6 weeks. Of course you should be investing. I know there are a smattering of people of you who are, of course, interested in online real-time intraday investing. Well, sometimes they may help you stay on the right side. But this is meant mainly for those of you who want to enjoy a decent ride of several weeks to hopefully several months. And I'm going to show you there were at least 7 points in time in the last 2 years, since March of 2009, when you could cheerfully have engaged and you would have made good money. Next slide. And there it is. We went from hope to joy to exuberance. And again, I'm getting to be a broken record, but get your beady eyes down to the bottom, and you see 2 Eurekas and a Kahuna, 2 Eurekas and a Kahuna, and off she goes. So if it's repeated itself, all these occasions, don't you think that there's something, a pony in there? Look at the gloom and doom. And of course, we'll be talking to much of that next week up at the top. Next slide. Now, let me put it in this different perspective. Oh, Ian, all these numbers, I can't stare at that. You don't have to. I've called it out for you. Look at the top on 1201. There's a Eureka. And look at the Kahunas all, what are you looking at? You're looking at Kahunas on the left-hand side, 0.42, 0.45. And of what? The SPX, the Dow, the NDX, the composite, etc. The 10 indices I follow. And all of them were extremely strong on that date. You go, you buy. And look what happened on the right-hand side. That's the actual percent B index itself, the Bollinger Band percent B. All you got to look at is it's green, 9/10 of it is green. But then I get you to look at get down here at the bottom right. And what you see is these are 10 market indices, and they're all above 1. 1.04 on average, as you can see, 1.03 on average. What does that mean? That means on average the market is well and truly overbought. And what do you expect? From there you're going to expect that there's going to be some trouble. And would you believe it, the very next day on 0119, after all, which is only, let's see, face it, 8 days ago, we had a Phoenix. And look at it. As you well know, if you are in fact in tune with the market, you know that the Russell 2000, you know that the mid-cap, and you know that the 600, S&P 600 were going like gangbusters, as you can see from their numbers. 1.11, as you can see down there, and then they got clobbered. Look at it, minus 0.77, and clean them out. That's the message. So then the question is, well, all right, that's just the first shot across the bow. When, in fact, do we have a correction? Who knows? We'll soon find out. But at least you had a couple of days warning that things were getting a trifle overheated. Next slide. And there they are. You say, hey, Ian, I don't want to do this business of watch the market all day long, etc., etc. Show me, if you will, in the last 18 to 20 months, when should I have got in and when should I might have got out? And I'm showing you right there that during that period, there have in fact been 5 occasions. And the most recent one, you might quarrel with me and say, come on, Ian, 101 days, 5. I see the little red candle there, be my guest. As you know, that's only a matter of the last 2 weeks where it paused to refresh, and now it's gone for 101 days. And if my memory serves me right, of course, all the pundits are writing about the fact that lo and behold, the S&P 500 has been up 33 days in a row above the 10-day moving average. I put that on my blog as well. I hope many of you trot to my blog. We'll give you a reminder on that because all this good stuff is there. All right, so there you are, 5 strong rallies in that period. And let's look at where they were. Next slide. And there it is. Now what are you looking at? You're looking at signals that are generated automatically through filters in HGSI that are green and rose. And look at it. There it is, 310.09. Get with it. And again, 713, 1105, and 211.10. I mean, it doesn't need a lot of explanation. But look at that window. That is, in fact, what I call bullseye. There's those periods where the green comes down through the red, and you should be out, or at least doing something to protect yourself. Then it flies up through it, and they're off again to the races. So there's those 4 occasions. And you know darn well that that was the time for you to have, in fact, got in with your stocks or your ETFs or whatever. Next slide. And here you are. I've put 211.10 to remind you on the left-hand side again. But there's the picture this year. And you say, hey, Ian, there's a bit of yin-yang. Of course. When you see that kind of yin-yang, as I call it, between rose and green, that says, hey, you better be darn careful. That is a false breakouts. But ultimately, you get a green signal, and off you go. So there you are. This last one was only a 4% correction. But look at it. Look at the false signals that the likes of the cancelers had to put up with. Because, of course, they were, the newspaper was saying, hey, we're off again. And no, turned down again. All right, at any rate, next slide. Well, somebody in the audience asked, hey, Ian, have you done any back testing? And yes, of course. Obviously, Connors is famous for his techniques, but he's a primarily very short term, of the order of 6 days. And as you can see, there's a comparison between Ian's %B and Connors %B. And you cast your beady eyes down the list, and you see immediately that he's a little better than me in the period of 5 days. But then I'm almost double his as you go out further. That's no reflection on his style. It's a question of styles. But I'm saying for those of you who are interested in garnering opportunities and wealth in your portfolios, this is the way to address it when you get a signal. Next slide. Now, of course, at this point in time, and those of you who follow me on the blog will recognize this chart and know it by heart. But as you can see from the green, and what are you looking at? You're looking at the %B of stocks above 0.5, in other words, above the middle Bollinger Band for the S&P 1500. And as you can see, there were just 2 weeks of pause to refresh. And there are 22 weeks that we've been at. But you can see that in the last 3 or 4 weeks, it's kind of yin-yang up and down. And sooner rather than later, I expect that somehow, somewhere, they will hit this market again and take it down. But at the moment, of course, it's off again to the races. So play as you like. But notice the important thing, that there's a divergence. And so I'm going to show you that. Next slide. Now, here's where Grandma's pies come into play, along with bucket sloshing or bucket brigade. Now, I give you 2 important pieces here, and they, in fact, indicate that Grandma's %B pies go soggy at 65.35. In other words, you better have your finger on the pulse if you're in a particular stock and wondering whether, in fact, it's in trouble. But for sure, your last chance is when it's 55.45. Who's to say in this market? It might go down to 50.50 or 45.55 and then bounce back again. That's the problem. we're faced with volatility. On the right-hand side, I promised you that I'd talk about bucket sloshing or the bucket brigade, and that's on the very next chart to make it come alive in terms of what am I talking about. Next slide. And there it is. There's the 12 buckets, and as you can see, I've split them into 4, 4, and 4. The red, of course, the fire brigade buckets are down at the bottom, left-hand side. That's where there's panic and fear. When percent B is below 0.3, I'm suggesting to you that in fact is tough road hoeing. And on the right-hand side, with those beautiful buckets, it's safe and thrill. In other words, above 0.7, you should play. And in between, obviously, is the caution. And I've given you signals for go, and I had panic. I should have had sell, but couldn't find a thing that's nice red button that said sell. So there you are. There's the ground rules, and you understand that now. Buy when the market skips 2 or more buckets, and a Eureka and Kahuna up. You got it. That's it. And same thing goes on the sell. Next slide. And you say, oh my heavens, Ian, how can I make head or tails of it? Very easy. Look, start on the bottom left-hand side. Bears in control. You'd expect that. It's 80% between friends. 80% red, 21% green. And by the way, I chose this. Look at the dates that I chose them, just to show you what it looks like when it's 80-20. Bears are in control, and of course everything is sloshed to the left, as you can see. Then 59-41. And on recently, as just last Friday, it was 59-41. And I said we were here. And so you go around all the way to the other side, and a strong rally is very evident, and it's all sloshed to the right-hand side. But here's what I want to point out to you. It was only a matter of 9 days ago. We were sitting fairly happy on 1/18/2011 with it sloshed to the right and 70-30. And just 1 day later, it had moved to 50-50. So that's the volatility that you're having to put up with, you and I. And of course, one of the clues as to which way it might go, or about, I should say, teetering on the edge, is when you see that picture called bifurcation in the top left-hand side. And you say, well, all right, Ian, show me what's happened in the last week. Well, let's turn to the next slide. Aha. I'm saying that the market is behaving like a dromedarian, a two-humped camel. There you are. That's bifurcation for you. Next slide. And there it is. In the last 7 days, and by the way, you'll notice as you go down from the top left, you go down, the only date that's missing is 1/20th. I wanted to get an even 6 on the chart, and I left 120 out because it gave us no additional information. But there you see in 2 seconds, 3 occasions in the last week where you've had bifurcation. That spells certain uncertainty to me. Yes, of course, you might ask, where do we sit right now? Well, on 126, which was yesterday, we were 37.63. And you say, well, what's it today, Ian? Well, I'll tell you. It's 36.64. So it gained 1 point to the green side. 1. All right? But at least it's sloshed to the right. Be thankful for small mercies. Next slide. So I say to you, here's an easy way for you to measure the ebb tide. Measure of the ebb tide of the market, or of your stocks for that matter. And as you've now begun to understand, if there's the high tide, all boats have risen, and you'd expect the sloshing to be on bucket number 12, which is percent B greater than 1. And if in fact it is low tide, then it's the opposite, as you can see. But it's the stalemate which helps you determine which way to go. Because it's very seldom, I tell you, it's very seldom that you would flop from one side to the other without going through the middle. And that's the important piece that gives you that heads-up warning. By tonight, after this webinar, I'll have yet another blog up that will cover these last five slides. And I offer to you that to understand much of this stuff, these last two blog notes of mine will in fact give you a refreshing course. And with that, I'm done. And now I turn it over to Ron. Are there any questions, by the way, at this time? No, you seem to be very happy, and I pulled it back so that we're right on schedule. So Ron, take it from there.
Okay, Ian, why don't you just speak up whenever you want to, and yes. We'll go ahead and get started here. I have updated the database. As you can see, the last date is 1/27, so this is all current data. Now, when we were looking at this a few days ago, the market was in a different situation, and it's obviously rebounded from that point, but we can still get a feel, or we can look at the impulse indicators and see if they're giving us any signals or not, or we can look back at a few days or a few weeks or months or whatever and see what the signals were. But what I've done here is I have created a folder in the designer. Now, I assume most of you who are on here are HGSI users or are thinking about using the product, but to keep the focus narrow for tonight, I have just put a couple of folders here in the designer containing indexes. One contains indexes and one contains a few stocks that we all know about. And what I want to explain for some of you who may not know this, that when you look over here at this symbol column and you see a symbol with an index in here, that means it's an index created by HGS Investor, and it's created by a list of stocks in this case. Now, you can make groups out of ETFs or anything else, but the key thing is when you see the word index, it's an HGSI index. Now, I also have some cap-weighted indexes in here. The NASDAQ, we're all familiar with that. The NYSE, the Dow Jones is a price-weighted index, and the SPX is down here, but it doesn't have anything in these force index columns. Now, I'm not going to talk about the force indexes tonight. That'll be the next webinar, and we'll go into those in depth. But a lot of indexes do not have volume, and we want to analyze volume, especially with these impulse indexes, especially with the force index. Not so much the Kahunas. They don't require volume. They require a big move. We like to analyze volume. So I have put all of these indexes in here, which are created by HGSI, so we can also analyze the volume. We do not get a true reading for accumulation distribution, because one of the main factors in accumulation distribution is volume. And by the way, in the next webinar, we're going to talk about the force index, and we're also going to talk about accumulation distribution, or the percent AD. Now, I'm going to, before we look at any charts, I'm going to quickly move down to the S&P 1500. Now, there were 1,500 stocks in here until yesterday, and one of them must have been a buyout or something, but that'll get fixed. We'll get the latest listing, and that'll be in there before long. But this little icon over here is called the Spectrum Analyzer. It says Spectrum Analysis when I hold my mouse over it. And what this lets us do is open up a view, and you can see it's just a dark circle now because there are too many slices. But Ian showed you all of those percent D breakdowns. Now, that's with a different program, but we can simulate it the slices, and I typed a 2 in here. Now, this isn't a perfect split, but it's close enough so we can get a feel for it. This value of 0.5473, which is represented by the blue, that tells me that 60.17% of the stocks are above 0.5473. Now, Ian was talking about 0.50 being the break point. So we know that this is almost 0.05 heavy, but quickly we can see by looking at the slice that the emphasis is more towards the bullish side. If you're thinking in terms of bullish and bearish based upon where the percent B is relative to the middle band, which is 0.5. So a quick read here, we would just add another 5% on there and be about 60. What did you say it was today, Ian? 65%?
64.36.
Okay, so I was close. Okay, so I was just saying that here's a 54 cent. To get it down to 50 would be adding about another 5. So we get a quick read here, and it's showing more of a bullish.
You might just get closer, hopefully.
Well, let's see. It works very quickly, and I sort on the value. Well, it isn't any closer. We don't have a closer break than that.
Try 13. But there you are. There's trial and error. Do you follow?
You're going to make me work at it.
Yeah.
Now goes down to 47. Let's try 12 and give up on it. No, didn't do it.
All right.
Anyway, go ahead.
That's how you can do it.
So that gives us a quick read on how the percent B is breaking out. Now let's go back here, and what I'm going to do now is I'm going to open up a couple of charts, and I'm going to put the Russell on the right, and that's not the chart I want, so let me go to, I was in here looking at my I keys, looking at the accumulation, and that's something we're going to talk about next time. So, but what I have here is one chart, and I'm going to open another chart, and it unfortunately took me back to that one I was looking at before, so just bear with me for a second here, and let me see if I can do this. That's about 50-50, isn't it? Close enough.
That's good.
Okay, now what I want to show is when we're talking about markets here and Kahunas and Eurekas and everything else that Ian has been discussing, that it really depends on the Dow recently, but the Dow is made up of 30 price-weighted stocks. It's totally different than the Russell 2000, which doesn't contain 2,000 stocks. I think it's close to it when they rebalance it every year, but then stocks fall away. And but anyway, they're primarily small cap stocks is the point that I want to make. But look at the difference here. But let's go down here and look at these windows with the Eureka and the Phoenix. One thing you need to remember about those numbers are all based upon the NYSE, or the New York Stock Exchange. So it doesn't matter which market chart is up here. These are always going to be based upon the data from the New York Stock Exchange. What differs are the Kahunas. Now let's look at the Dow. On this major move up here, there was a Eureka and a Kahuna on the same day, and that corresponds to this move right here. I'm going to hit my alternate C chart, and we aren't going to discuss these tonight except for the percent B and bandwidth. This was already positive. It hadn't come back down through. But look at the move here on the Dow, on that gap up, and this is the force index, which we'll get into next time. But all of these confirming signals were up here at the same time this was happening. So when Ian was explaining about the force of the move with the Eureka and the Kahuna, you're going to generally be able to have all of these confirming indicators up here. Now let's look over here at the right-hand side, at the Russell 2000. Here was a Phoenix the other day, and this market sold off. Now look back over here at the Dow. It didn't sell off. It stayed above and shot right down through it to the 50-period moving average, and at the same time there was a big Kahuna to the downside. And now look what has happened. There's been a Kahuna to the upside. This is the volatility that he's talking about. but you can see that volatility represented by these kahunas. One more thing, on this down day, you can see all of these indicators, or most of them, went down, and then the percent B came down through the bandwidth line also, and then it turned up and gave a signal on this first day right here. So it was earlier by 2 days ahead of the kahuna. So if you watch all of these, you can really get a lot of information out of these. The point is not all the markets are the same. Some of the small caps generally lead up and down, and that's what happened. More thing, let's take a look at the NYSE. It didn't break either. It remained very, very strong. Sure.
All right. And if you look at that point in time, which is 12-1, that Ron was pointing to, notice that we have on the Dow 2 Eurekas and 2 Kahunas with a big Kahuna down at the bottom. Now get your beady eyes over to the right-hand side, Russell 2000. And if you go to the NYSE, you'll find it's all hit on the same point in time. That's big caps, small caps, and so on and so forth. Depends, as Ron has just very nicely shown you, how some of them get trashed. And as I said earlier, the Russell 2000 was taken behind the woodshed and trashed. There it is. But notice that kahuna that says, hey, they're buying into the beast again.
So anyway, let's just move on to the other charts. By the way, these charts are in the program. They're under Ian's charts in the reference groups, and you can just drag them up to the top of your list if you want to work with them. I've only dragged a couple up here, 3 of them up. And let's go to it's called the WG chart. The reason these have these names like WC and WG is that if you've been with us for a while, you know that these all used to be assigned to keys. And now we have the quick pick method, which you can move around very quickly, just pointing finger up here, and then you can select any chart presentation. And that's another very nice thing about HGSI. You can tailor the program to your investing style. Now let's take a look at these with the WG chart. Now these signals are determined by a filter. It's called a visual filter backtest. You're going to get a signal. Now let's take this, look at this process again using the Dow. Now this is a kahuna, a big kahuna, and 2 Eurekas down here, and at the same time, so it's holding up, but we have major signals here, and in addition to the kahunas and Eurekas, we now have a signal based upon the filter. So that was the beginning of the run. So what you're getting here is multiple confirmation, and that's what we like to see. Now over here, let's see, I need to zoom out a little bit, don't I, Ian?
Yes.
I want to go back to the 9 period. I'm in a little close here. Let me zoom out. Now, did I go too far there? No. Okay. So here we are back in September of last year. We had, look at this. Well, there's a Eureka, and then we got a down signal of Phoenix the next day, but it was a one-day signal, and then we had 2 kahunas, 1 kahuna and 2 Eurekas in a row, and we had a signal, and this was coming up through the percent B, the percent B through the bandwidth. So there were multiple signals once again. That's what you want to look for. Here's a confirming signal, a Eureka, a kahuna, and then a signal based upon the filter. Then we had some downward action, little bit of whipsaw through here as the market was basing and trying to go up, and then when we had the signal, there was a kahuna here, but there was a big kahuna here, which means more of a violent move to the upside along with a Eureka. So once again, multiple confirmation. Now we're going to go look at some stocks here in a minute too, and you'll see that stocks are showing very similar patterns, and when everything's moving together, it's a pretty good indication that the market wants to go up or down. So here is the same period with the Russell. Now notice that the Eurekas are here. Here's the Kahuna, here's the signal, and here's the percent B through the bandwidth. So what you're looking for is multiple confirmation, and if they're moving up, especially if the price is in between the 0.50 and the 1.0, and we're getting confirming signals on the Eurekas and the Kahunas and the signals on the chart. It's just more confirmation that there's a lot of buying power behind this market. Any comments, Ian, before I move to the
No, I think that's fine. That's great.
Okay, so we're just going to look at some single stocks, and I believe that's what's next on the agenda. So let's just go to the designer quickly, and we'll go to these stocks, and I'm going to sort, and we'll bring up Ralph Lauren first, because that's the one that Ian pointed out, or one that he pointed out in his presentation. Now let's go back to that same time period. If you recall, the markets, and I'm sure you do, we've said it many times, but around this September 1st period, the Eurekas were firing, the Kahunas were firing. Now this Kahuna is based upon the stock. Remember this. This is always stock or index specific. So we have the markets. It's telling us down here that the market's going. This is telling us that the stock wants to go, and then we get a signal here on the stock. And another very important confirmation is this dotted line. Now I've added the group line to this chart because I wanted to show you that if the group is also moving along with the market indicators and the percent B indicators signaled by the Kahuna and this signal, and the group is moving too, and then this percent B is going up through the bandwidth. Even if it doesn't come down through it, if it gets down near it and then turns up sharply, that's a confirming signal. So everything is lined up here. We have the Eurekas, we have the Kahuna, we have the signal here, the group's moving, and the percent B through the bandwidth, and that should be enough confirmation for anybody to at least start getting into the market. And then you can see what happens over here. We start, but that was an upside down and a Phoenix, which negated any possible move up on this stock. Any comments before I move on?
No, that's fine.
Okay. Okay, did I click that? Oh, I know, I was down at the bottom. Let's to the top. Apple. Everybody's familiar with Apple. And here in a double Kahuna here, back to back, and two signals within 2 days. The percent B through the bandwidth had already gone up, and the group was already on the move. So it's the same story. We're looking. We had some down movement. Apple moved down to the lower band, as you can see, and then we had three signals here in a row. At the same time, we had three Kahunas. There was that Phoenix, but the next day there was a Eureka right behind it, and then another confirming Eureka. And as we all know, Apple made a huge run up here, and still until Steve Jobs said he was leaving just as a minute support. Earnings came out, and it was at that time it was buy the rumor, sell the news, and now it's turned around again, and it's back right up here at this point. It's probably a little hard to see, but these are little narrow bodies. So will we see what happens to it? See if it's running out of steam or not. But the point is, there were multiple confirming signals. These three signals right here were also confirmed by the group moving up. You can see the dotted line right there.
Ron? Okay.
Yes. Back to Apple?
That's all right. I'll stay with this one. I can do it here too. Would you be good enough to pull down the window on Bullseye? We want to talk a little bit about the green and red. You see how that the percent B comes down through the bandwidth? That's a sure sign, and look how fast it comes down. That's a sure sign that there may be a correction, and as you can see on that one, it was only minor. But look at the beast on the right. I mean, as you well know, earnings disappointed or whatever it was, they trashed the stock. And of course, now the bandwidth has risen to 0.5. As you can see with a stock like this, which is highly volatile, as you can see from the Bollinger Bands themselves, you will see that the bandwidth is big. So you have to be very careful in terms of ensuring that the green is above the red.
Okay, so I'm trying to point out the width here. This shows you the volatility of this stock. Now, in the nice tighter stocks that we generally like, you'll see the bands being much tighter than this, and you won't see these extreme moves. But this has been a great stock. Obviously, it was $65 down here, and it got up to $145 before the earnings disappointed. And this is the danger of going into earnings season. It's a crapshoot. No other word for it. Netflix was great, but this stock, and tonight Amazon disappointed, and it's going to be down big tomorrow too. So, but anyway, getting back to this, when the buy signal, the group's going up, and the percent B was already up through the bandwidth. Had a nice run and then pulled back, then got another signal here before the big gap up, and it rode that up, and there were some good signals here too. And this, of course, happened on the down day. You'd have been out of luck there.
So let me hit this one here. Notice that big kahuna in the middle, that dark blue kahuna, and look at the gap. This thing is going to gain. Well, of course, you'd like to have got it 2 days before, and there it is. Shows the signal 3 days before.
Okay, we'll go down next one. First Solar, another extremely volatile stock with multiple signals. It's just a repeat performance. The percent V was already up through the bandwidth, but everything else was moving in sync. And I keep mentioning this because it's so important to have the market, the kahuna, the group, and the signal all going in the same direction. If you have the market and the group going in the same direction, and you're in one of the leading stocks, you've got a much better chance of success. But this stock is, if you don't have ulcers, you would if you owned this one and held on to it. So just another example. Look at Ford. We're going to contrast this one to the prior one. Same signals. The Eurekas, we didn't have a kahuna here, but we had two signals here. The group is moving up. The percent B is through the bandwidth. But notice how tight Ford is relative to those other stocks. On its move to the upside, it stayed inside the upper band, and it got outside of it, which is very strong there. Came down, tried to hold the band here, but it did hold the band. This volatility increased the bands. Here is 0, here's 0.5, and here's 1.0. It did hold inside the band except for this day here. And then it narrowed. Notice, see the volatility coming out of it as the bands narrow, and then it broke again. Now here was a one-day signal, but that was based upon that Phoenix day. Here's another Phoenix day here. But when everything's moving together, you're going to increase your odds tremendously with these indicators. And I believe Google is the last stock we're going to look at. Once again, I sound like a broken record, but the market's moving. That's indicated down here. No kahunas this time, but 3 signals here. The group is moving. The dotted line's moving up. The percent B is up through the bandwidth, and Google ran from 455, had a huge gap up on this big kahuna, signaled that. I mean, it's after the fact, of course, but it just shows you the extreme move, and it moved all the way up to 624 from around 440. So huge move up. And then you can see multiple down days here. Another day which was the selling climax. You can see that with the volume. And then it started working its way back up here and got another signal, and a couple more here. Any comments on that, Ian?
No, I think you've done fine. I mean, and by the way, I'm looking at the clock, and we're right on schedule.
Yeah, well, we started a few minutes late, but that pretty much covers what I wanted to cover. Does anybody have any questions at all?
Yes, I see one. Please pull up and discuss ALLT, says Chris Tenhagen. So ALLT. You see how we're on the ball here? I have to keep an eye on that.
Good work, Ian.
Uh-huh.
Well, there's a tight stock.
Well, by heavens. There's a stock for you, 12 bucks.
Okay, Chris, here it is, fired on the Eureka's Big Kahuna, and the group was moving up. This is already above, and it stayed above the bandwidth, except but a confirming signal here.
Confirming kahunas, I mean, this thing is strong. As Gil Morales would say, and he's in the audience, hey, Ian, I see a pocket pivot. And there we go. But at any rate, pulling your leg,
Yeah.
Gil.
Chris, that's a great stock. I hope you bought it down around 4.5.
4.5. Yeah.
Do we have any more questions, or?
No, that's the last. That's the only one I see. It seems that I hope that you feel you learned a lot in a very short time, and hopefully we will do this again, of course, as Debbie has said, for the next 2 occasions. And by the time we're finished, we'll have been round the clock in terms of that WC chart. I say again, the WC chart is your roadmap to hog heaven. And once you understand what these impulse signals are doing for you, you'll say, yeah, I see it. And no matter what your techniques are, I just happen to use Gil's example, but obviously he focuses in terms of the moves, and they're very similar. We can point them out with this bucket skipping business. So there you are.
When we get into the next session, we're going to bring these force indexes in, and percent AD also, and maybe something else. We'll probably spend some time on the eye charts, because some of those have what we could consider impulse indicators too. But we're going to tie all these things together, and as you can see, using the stock that Chris suggested, everything was firing at the same time. So just more confirmation. And then as this thing gained momentum, you can see the buying power here with the force index. So if there aren't any more questions, I guess we'll end it tonight. And if you want to review this, it has been recorded, and it'll go up on the High Growth Stock website in the Learning Center. So I think we'll just, anything else, Ian?
Yes, I just remind you again, please visit my blog. If you'll give me about 20 minutes, I'll have a fresh blog covering the last five slides as well. But I tell you, there's a wealth of information that describes all this stuff, and just flick down through the blog notes and enjoy. But more importantly, we'd hope that some of you who may be newbies will say, hey, there's a pony in here in this stuff, and A, you'll join us again for the next 2 sessions, and B, you'll come to the seminar. The seminar is March 26th to 28th, and of course, part and parcel of our work is to try and get some of you newbies interested in seeing how we can teach you inside a matter of 3 days all there is to know about not only these indicators, but how to use that powerful product called HGSI. Thank you very much for attending, and all the best to you.
Thank you, and good night.
Good night.